Steve Peterson here with Infinity Investments, and welcome to our channel. We talk all things commercial and investment real estate. And in today's video, we're going to be talking about our 1031 success checklist. So this is a 9-point checklist that we have developed here at Infinity on how we go about executing 1031 exchanges on behalf of our clients. This is probably 85% of our business as brokers. And so we do a lot of these 1031 exchanges, and we develop a formula, a way, if you will, of how to execute one successfully. So it's a 9-point checklist. In today's video, I'm going to be going over our first point in the checklist. And we call it a success checklist because we are not just doing 1031s. We are doing successful 1031s with the goal of being not just deferring taxes. The real goal is acquiring a better asset than you sold while deferring the taxes. I want to make that clear that our definition of success in the 1031 is acquiring a better asset. Now, your better asset is going to speak to our point number 1 in our success checklist. And again, if this video is helpful for you, like, subscribe, share with a friend, comment on it, and let's stay engaged that way. What's going to determine what a better asset is what your investment criteria is, all right? And that goes to our point number 1 in our checklist, which is to create an investment plan. You got to have an investment plan, guys. You got to start with the end in mind. The end goal. Where do you want your investing career to take you? When you hang it up and retire, what do you want all your investment properties to achieve for you in terms of value, in terms of cash flow, in terms of cash, how many units, so on and so forth, right? Starting with that plan is the number 1 thing that you need to do when you're doing a 1031 exchange. You want to operate from a defined plan. Now, in the business world, entrepreneurs, we have a business plan. That's pretty much commonplace, right? Whether it's a 40-page, Harvard Business School business plan, or it's a 1-page, guide of how you're going to run your business. We all got some kind of plan, right, in the business world. What I find in the investment world is a lot of investors just, are going based on their knowledge, and a lot of investors are very smart people, by the way. So they can get by with just understanding real estate or understanding investments, understanding whatever it is they're going to do, and operating that way. But once you start doing things like complex 1031 exchanges in a heated market like we're in today, then it behooves you to be operating off a plan, all right? And within developing your investment plan, what you want to say is, okay, what's my exit strategy to this? And then a lot of people say, well, I'll never exit in real estate. Why would I exit the business? I can always hire somebody to run it for me. And you can do that for sure, all right? You still want to say, hey, look, when I'm 70 years old, or I'm 80 years old, or I'm 60, or I'm 50, whatever it is, I want to have, let's just say, for example, 1,000 units of multifamily properties. Or I want to have, 500,000 square foot of commercial, 500,000 square feet of commercial space. Or you say at your single family home, I want to have, 200 single family homes, right? So you have a target of how much property you want to have. Then what you want to really have is a target of how much positive cash flow is that portfolio that you have developed going to generate. And that number of positive cash flow should equal at least 2 times of your monthly operating costs. Now, what I mean by that is your personal operating costs. So your business has an operating cost, right? Your portfolio is a business. That portfolio should net to you a certain amount. And before you hang it up, before you retire, before you hire somebody else, before you give it to the kids, before you move to Costa Rica, whatever you're going to do, that's your investment plan. That's your exit strategy. That's your mountaintop. That net cash flow to you should be equal to at least 2 times your monthly expenses, your cost to operate your life. And I get that 2 times multiple out of the Robert Kiyosaki trainings, all the books that I've read, and particularly The Game, Cash Flow 101 and Cash Flow, is it 102? I think that's the second version, where maybe it's 201. But the second Cash Flow game, if you haven't played that game, by the way, you should play that game. It's real fun, and it really teaches you a lot about investing. But essentially, in that game, he talks about going from the rat race to the fast track. And in the first version of the game, how do you do that? The rat race was where you're living off earned income, and you transition into the fast track by having at least passive cash flow equal to your monthly expenses. So if your monthly expenses are $5,000 a month, you got $5,000 a month coming in, you move to the fast track. Now you are a professional investor, willing and dealing. Well, in the next version of the game, Cash Flow 202, I believe is what it is, it's double, right? And I think double is a good number if you're going to be setting up an investment plan for yourself to say, hey, look, say it takes me 10 grand a month to live my life. When I retire, I'm going to have 10 grand a month of expenses. And you might want to plan for inflation. I'm just saying, it's March 2022. Things might be a little more expensive in March 2042, right? So doubling your expenses, I think, is a good idea. And your investments should be generating enough positive cash flow to take care of your expenses and then some. So that if it is a problem with anything in your life, if it is a problem in the business, you got enough cash flow to handle that. Why is that point important when we talk about 1031 exchanges? It's very important about when we talk in 1031s, because every move that you make, every move is a calculated step. It's not just you shooting from the hip. I just want to sell a property because we're at the top of the market and buy a bigger one. When you sell that property, you should know what your return on equity is, and you should know that you are targeting an asset that's going to pay you more than you're making on your equity today. And that is in an area that's going to see some growth over the next 5 to 10 years, 20 to 15, 20 years, whatever. And so that, therefore, you can make your decisions when you're selling, when you're buying, when you're doing due diligence, when you're evaluating based on the end goal. Too many people just get caught up in a transaction, forgetting that that transaction is part of a portfolio, or that transaction is part of your business, that transaction is part of your plan. And I am urging you to, number one, develop your written investment plan with your end goal in mind, and then begin everything you do, begin working towards that, especially when you're doing your 1031s. And what's going to help you is when you click the link below, download our free 1031 success checklist, and begin working through that process as you're executing on your 1031s. I hope this was helpful. If it is, like, comment, share. If you don't like it, tell me I'm an idiot, whatever. It's all good, man. I appreciate you guys. Until the next video, best of success in your investing career. Peace.